Hi, this is Dan Collins, editor-in-chief of Modern Trader Magazine, coming to you live from the floor of CME Group for Traders Exclusive. Today is December 8th. Wanted to talk a little bit about Fed funds. We're a week ahead of what we expect to be the first and only rate increase for 2016. Seems cooked into the market. There is some concern about how the market will react, which seems a little bit odd because it's pretty much a done deal, most people believe. Perhaps the surprise nature of the election might have changed people's outlooks on this, but with the market recovering and rebounding, it's pretty clear. The interesting thing is that the Fed funds markets has been separate from what the Fed had been showing a year ago and 2 years ago with its dot plot and expectations. The market actually has been right because the market has expected less of a move than we had, and as you know, there's expectations of a couple of tightenings in 2016, maybe as much as 4 at the beginning, but I think most people limited it to 2. But with Brexit coming in the middle of the year and worries about Brexit, that eliminated that kind of mid-year potential for a tightening. The really bad Q1 2016 calmly pushed that out and locked in, a maximum of 2 increases for the year. Brexit made it 1. Now, if you look at the market, most analysts expect continued steady growth, 2 rate increases in 2017. I think that's where we're at. And that's where we were at before the election, when the market expected Clinton victory and for economic policies to remain the same. She would have tried stimulus, but she wouldn't have gotten too far. Probably not as far as President-elect Trump will get, and he wouldn't have this massive tax cut that he's talking about. Both of those things are stimulative and potentially inflationary. And after a scary bump on that day of the election, or the next day of the election, where the Fed funds shot up as the market dropped 100 points, the S&P's dropped 100 points more in the Dow. As it rebounded, as the market rebounded higher, Fed funds settled down. And if you look at the Fed funds rate for January 2017, it's looking at in a tightening, a 25 basis point tightening this month. You look out December, January 2017, 2018, they're looking at 2 rate increases. That's exactly where we were before the election. But now if you work in the potential of the beginning of a large $1 trillion stimulus package and a large tax cut, if it comes, that would be more stimulative, it would be more inflationary, and it might leave room for the Fed to be a little bit more aggressive in their tightening. Of course, how aggressive they can be also depends on the rest of the world. One of the arguments against them moving is they can't be moving higher when the rest of the world is still moving lower and negative. The ECB announced that they will begin tapering from its QE in April. Pretty weak announcement that they're wait until April and they'll start tapering from I think the 80 billion euros a month that they're buying. Whether this gives the Fed a little bit more room is a question. Of course, the Fed is not supposed to be looking at Europe, but we know they have. We know if Brexit vote affected the Fed activity this year, and the problems, economic crisis in China affected their actions. So right now, the Fed funds is priced perfectly as was the expectations under a Clinton presidency. With Trump, if he accomplishes some of the things that he does, you would think that the Fed would need or want to tighten a little bit more aggressively. So there's movement there if you think they would. Right now, December 2017 Fed funds are about 9.889. So we're about a 1.25%, between 1 and 1.25%, which would represent 3 additional quarter point increases. So it'd be interesting to keep your eye on that. and see what the dot plot at the Fed, how that moves. They've shrunk it in the last year. Now with some of the policies that Trump administration that may be going out wider, and there may be room to go long some of the Fed funds futures going out a year or two. This has been Dan Collins for Traders Exclusive. See you next time.